Something just happened in the financial markets that has only happened a handful of times in the last half-century. Not a cute pattern, not a social media coincidence, a real pattern. The sort of pattern that tends to appear when the math under the financial system starts to crack, and the people running the system are about to make the one decision they always say they do not want to make. They print. That is where I want to begin, because if you understand that sentence, you understand almost everything that matters in a setup like this. Most people spend their lives looking at markets one asset at a time. They look at gold, then they look at stocks, then they look at bonds, then they look at real estate, then they look at Bitcoin. They treat each one like a separate story with separate headlines, separate personalities, separate little narratives. I do not think that is the right way to look at it. In moments like this, the market is not telling you 5 different stories. It is telling you one story in sequence. That is the first rule. When the system gets stressed, assets do not move randomly, they move in order. And when you know the order, you stop reacting after the fact and start positioning before the crowd even understands what it is looking at. Now, let me show you the signal. In late February, gold was sitting near all-time highs, around $5,600 an ounce in the source framework. Then the Iran war broke out. Every talking head on television expected the obvious playbook. War means fear. Fear means safe haven demand. Safe haven demand means gold should go higher. Gold did the opposite. It dropped 25% in less than a month and fell as low as around $4,100 in late March. That shocked people because they were still trying to read the market with glitch phase. War starts, gold rises. That is the cartoon version. The market does not always work in cartoons. What makes this move so important is not simply that gold fell. Gold can fall anytime. It is that a drawdown of this size during a major global crisis has only shown up a few times in the last 50 years. The source material calls out 1973, 1978, 2008, and now that is not a throwaway statistic. That is a very rare signal. And every single time it happened, what followed was not just a polite recovery in one corner of the market. What followed was a full repricing across major asset classes in a specific order. That is the part people miss. Gold is not the story. Gold is the alarm bell. Gold is the smoke detector. Gold is the market's way of telling you that the people in charge are about to be cornered by arithmetic. And when governments get cornered by arithmetic, they do not choose discipline. They choose survival, they print. That is the second rule. If the system can either take the pain honestly now or dilute the currency and postpone the pain, it chooses postponement almost every time. Now let us back up and look at those prior episodes, because this is where the pattern becomes almost too obvious to ignore. In 1973, during the OPEC embargo and the Yom Kippur War, gold dropped sharply and then exploded higher afterward. In 1978, during the Iranian Revolution and the collapse of the Shah's regime, it happened again. In 2008, during the global financial crisis, gold suffered a brutal drawdown and then ran hard once the policy response arrived. And now once again, in a major geopolitical and systemic stress period, gold sells off violently right when the public expected it to do the opposite. Why does that happen? Because the first move in a crisis is not always intelligent revaluation. Sometimes the first move is liquidation. People sell what they can sell. Leverage gets unwound, profits get taken, positions get reduced. Margin clerks do not care about your macro thesis. They care about collateral. So gold falls, sentiment collapses, retail investors panic, leverage traders get wiped out, and the media starts writing its usual nonsense about the safe haven trade being dead. Then, once the forced selling exhausts itself, the real story begins. The real story is not about whether gold is broken. The real story is that the math underneath the system has become bad enough that policymakers are walking toward the printing press again. That is when the sequence begins. But before I lay out the sequence, you need to understand the engine forcing it. Right now, the engine is oil. Oil matters here not because people like telling dramatic stories about the Middle East, but because oil is one of the cleanest ways for a geopolitical conflict to become a macroeconomic problem. Before the Iran war, roughly 20 million barrels of oil a day were flowing through the Strait of Hormuz. That is about 1/5 of global oil supply moving through one narrow choke point. When that flow gets interrupted, even partially, the world does not have the luxury of debating ideology. It scrambles for replacement barrels. Pipelines get pushed harder, emergency reserves get tapped, storage gets moved, temporary supply appears from places that were not supposed to carry the burden for long, and yet even after all that patchwork, the shortfall can still remain enormous. The source material frames the real gap as more than 11 million barrels a day in the early emergency math, with some of that replacement supply itself being temporary. Whether you quibble with the exact number or not, the point is clear. The world is suddenly short a very meaningful slice of oil, and that matters because oil is not just another commodity. It is upstream to almost everything. Diesel moves your groceries. Jet fuel moves your packages. Natural gas heats homes and powers factories. Petrochemical inputs run through industrial systems so broadly that the average person rarely sees how many prices are downstream from energy until everything begins getting more expensive at once. That is the third rule when energy spikes. The inflation effect arrives with a delay, but it arrives everywhere. People always want inflation to appear immediately in the official numbers, so they can feel in control of the story. That is not how this works. It moves through transport, production, inventories, contracts, and restocking cycles before it shows up in the data. Most people watch, which means by the time the average person sees the inflation, the machinery has often been turning for weeks already. Now, there is another reason this setup is more dangerous than some previous episodes. Last time the government had a cheat code in 2022, when oil spiked around the Russia-Ukraine conflict, the administration opened the Strategic Petroleum Reserve and used it to flood the market with emergency barrels. It bought time, it softened the blow, it gave policymakers a way to relieve pressure without immediately letting the full market shock run wild. That cheat code is weaker. Now, the SPR is at much lower levels than it was before. It is not the same buffer. That means there is less room to smooth the spike. The market has to absorb more of the reality itself. And there is a line that matters here. Historically, when oil consumption as a percentage of GDP crosses a certain threshold, recession odds rise materially. In the source framing, the line in the sand is around $120 a barrel. Once you get around there, the burden on the economy becomes much harder to pretend away. And that is where the story stops being just about oil, because the economy was already wobbling towards slower growth. Now you are layering an energy shock onto an already fragile system. And that brings us to the piece of arithmetic I think matters most of all. True interest expense. It sounds boring, it is not. True interest expense is what the government spends on the things it cannot politically avoid. Things like interest payments on the national debt, Social Security, Medicare, and the other core obligations that do not disappear just because tax collections disappoint. According to the source material, by February, that number had reached 104% of federal tax revenue. Read that carefully. It means the government was already spending more on its unavoidable core obligations than it collected in taxes before a recession, before tax receipts take another hit, before the war as longer tail fully arrives, before the official inflation pass-through shows up in force. That is a fiscal trap. Imagine a household where rent, car payment, utilities, and debt service already exceed the paycheck. Every dollar for food, gasoline, school expenses, and repairs has to go on the credit card. That is not a budgeting issue. That is a structural issue. That is what is happening here. And when recession comes, tax revenue falls, income falls, capital gains shrink, corporate profits soften at the exact same time. The obligations do not fall, they rise. So the system is being cornered from both sides. The inflow weakens, the outflow hardens. That is the fourth rule when the government's non-negotiable bills outrun tax revenue. Monetary debasement stops being a theory and starts becoming a policy path. Now, people still like to pretend there are many options. There are not that many. Policymakers can let the system crash and absorb the full pain. They can slash politically untouchable spending hard enough to create immediate social and economic violence, or they can print. If you study 1973, 2008, 2020, or almost any modern crisis, you know what they choose. They print. They always hate admitting it. They always wrap it in other language: liquidity support, emergency stabilization, temporary facilities, market functioning. But the result is the same: more dollars. And once the system gets more dollars, the money does not flow into everything equally or all at once. It moves in waves. Now we can finally come to the sequence. Wave 1 is gold and commodities. This is where the signal starts. Gold sells off in the liquidation phase, then stabilizes, then begins recovering before the policy response is obvious to everyone. Why? Because the smart money understands the same math we just walked through. Central banks, sovereign funds, macro allocators, and institutional players can see the trap. They know what happens when energy stress meets fiscal weakness. They know what usually follows, so they start moving into things that cannot be printed. That's why central bank gold buying matters so much. It is not an opinion poll, it is positioning by people who understand monetary deterioration better than television panels do. Commodities broadly belong in this wave too. Energy, industrial metals, agricultural products, anything scarce, real, and globally priced in dollars becomes more interesting. Once the market begins to smell debasement, that is where we are now. Wave 1 has fired. Gold has already bounced from the panic low. The exact level is less important than the pattern. The signal has started. Wave 2 is the dollar. This part confuses people because right before the dollar weakens, it often gets stronger. That is not a contradiction. It is a phase. When oil spikes and global funding pressure rises, everybody needs dollars to pay bills, service trade, cover energy imports, and defend existing positions, so they sell other assets to raise dollars. That pushes the dollar higher in the short run. But that strength is built on desperation, not confidence. That is the distinction. The same process that forces foreign holders to raise dollars can also push them to sell us treasuries or other dollar assets to get the cash. That makes us fiscal math worse. That increases the pressure on policymakers to print or ease, and then the policy response undercuts the very dollar strength that crisis demand created. You saw this in 2008, you saw it in 2020. The dollar was strong going into the printing phase. The printing phase was what weakened it. That is why Wave 2 always matters so much. Once the policy response becomes real, the strong dollar story begins to roll over. And that rollover amplifies everything that Wave 1 already started. Commodities priced in dollars gain another tailwind. Imported inflation gets worse. Purchasing power weakens. The system moves from scarcity panic into currency adjustment. Wave 3 is hard assets. This is where real estate land. Infrastructure, type exposures, resource businesses, and other tangible asset categories begin repricing in earnest. A lot of people misunderstand this move because they think rising hard asset prices automatically mean life is getting richer. Often it means the currency is getting poorer. A house does not have to become more productive to sell for more dollars. That can simply be priced in a unit that is being diluted. That is what happened after 2008. Real estate eventually bottomed and then ran for years. Not because the economy was some perfect paradise, because liquidity flooded the system, rates were crushed, and the dollars used to price real assets lost purchasing power. The same logic held in the 1970s. Real estate and other hard assets were not merely surviving inflation, they were part of the inflation response. Commodity producers matter, especially here, because they own real things in the ground or in the production chain, while their liabilities are often fixed in weakening currency terms. That is a very attractive setup when the money unit is being diluted. Wave 4 is the liquidity wave into risk assets. This is where people who only think in old categories start getting blindsided. Once the Fed is openly printing and the currency is weakening, liquidity starts hunting harder forms of scarcity further out on the risk curve. Equities broadly participate, but not equally. The companies with real pricing power, real assets, or real leverage to reflationary conditions do better than the flimsy stories. And then the truly scarce digital assets enter the conversation. This is where the source material puts Bitcoin. Not as a toy, not as a meme, as the logical endpoint of the liquidity sequence. That framing matters. Bitcoin is not being treated here like a technology stock or a teenager as speculation vehicle. It is being treated like fixed supply monetary scarcity native to the digital financial system, 21 million units. No central bank can print more. No government can manufacture supply just because it wants an easier quarter. That is why liquidity eventually notices it. Bitcoin did not exist in 2008, but it was born out of that exact crisis. After the 2020 printing cycle, it did what a hard scarcity asset does when trillions of dollars start sloshing around looking for a home. So the order matters: gold and commodities first, then dollar weakness, then hard assets, then the broad liquidity wave into scarcer risk assets, and every wave lags the one before it. In 2008, gold bottomed first, the SP bottomed later, real estate bottomed even later. That is how sequences work. Money does not teleport instantly. It moves. And if it moves in order, then your portfolio cannot be built like a static museum exhibit for a world that no longer exists. That is the fifth rule. The biggest risk in a regime change is not a crash. It is being positioned for the old regime while the new one is already unfolding. Most people's portfolios were built for slow, orderly growth, low inflation, stable currency assumptions, and a generic 60/40th type of environment that worked for a long time. But if we are shifting into a system defined by oil shocks, fiscal overload, renewed printing, and a weakening dollar, then the old structure is not just missing upside, it is standing in the path of repricing. Long-duration bonds suffer in inflationary repricing. Cash loses purchasing power. Growth stocks with no real asset base or real cash generation can get compressed when the cost of capital rises and the market starts demanding something more tangible. So the question becomes very simple. What does your structure actually own? Do you own anything that benefits from Wave 1? Do you own anything that can survive or benefit from Wave 2? Do you own hard assets for Wave 3? Do you have any exposure to the scarcer end of Wave 4? Most people, if they are honest, can say yes to maybe one of those. Some cannot say yes to any. That is why cycles like this create such strange outcomes. They are not just about being right or wrong on one trade. They are about whether your structure matches the environment. And that is why people who build serious wealth through these shifts rarely do it with one dramatic all. In bet, they do it with layered preparation. They build exposure across the sequence, not in equal weights, not all at once, but intentionally. They do not chase the final wave after the first three already moved. They prepare while the sequence is still early enough to be ignored by most people. That is where we are now. Gold has already fired the flare. Oil is doing its part. The fiscal math is deteriorating. The print response is not yet fully official, but the logic leading to it is already visible. That means the sequence is not a theory anymore. It has begun. The only question left is whether you want to be positioned ahead of it or standing behind it asking what just happened after prices have already moved. I know which position I prefer, and if I were building for this environment, I would build with the order in mind. Not just the assets, the order, because in cycles like this, knowing what moves is useful. Knowing when it tends to move is where the real money gets made.